Good afternoon, everyone. This is Henry Gambell with SimplerOptions.com, and in today's free video, I wanted to spend some time discussing the ins and outs of unbalanced butterflies. The idea came to me because into the end of the day, we had two earnings trades that we were looking at, and they're both essentially exactly the same thing, just in opposing directions. So let's first start off with the trade here in Yum. So when I look at this chart, the thing that I liked about it the most is that you had the 21 EMA that was coming into a conversion right here at 84.2, essentially offering support at this level. So the way that I'm thinking about it is that even if the report is bad, I would like to see that it could hold this on a pullback. Okay, that's where the strategy starts to become so attractive, because what you can look at doing is setting up spreads, and this is where these unbalanced flies become so useful. But you're setting up to where you're taking advantage of the primary part of this strategy is selling the 84 put. So obviously that's got some good extrinsic value, and that's what we're selling. But by creating the transaction for a credit, in this case we ended up taking somewhere between 18 and 20 cents on them, this is where it sets us up so that if Yum explodes higher, we still make money. Because it's always frustrating when you set up a butterfly, like say you did it through calls and you're looking at it to the long side, and you get the idea right, but then you miss the strike by a little bit. You know, you kind of have to get right on those to do well with them. With this type of strategy, if I fall into 84, that's where we'll do the best. If we just rally, I have no risk to the upside, and then of course, as always, you want to define your risk to the downside by the number of contracts you take. So that all worked out pretty well, at least as far as the initial setup goes. Now looking at where Yum is trading here in the extended session, I believe they have already reported. So if we take a quick look at where they're at currently in relation to what this will do for our spread, and you can see how effective those levels tend to be. Now with it trading up here at 88, all that's going to do is yield me about a 20-cent credit. So we still make money on it, but had it opened up down here at this 84, that's where you really do well with it, and I've just found that to be a very forgiving strategy. Now I did that because this was a bullish trend, so on and so forth. If you flip over and look at it in DAL, it is just the inverse, and you can almost see how the chart itself is inverted just as far as price goes, because where Yum would have used 84 as a pullback to support, DAL has resistance right here at 40. So very similar concepts. You're sitting at the 50-day moving average, you're sitting right at your tree line at 40, and you're not far from the strike, obviously, the short $40 call. We initiate the exact same trade, except utilizing the short calls. So in this position, we do best if we pin at 40. Our risk is defined if we explode to the upside, and if we roll over and go back with the trend, we make a couple of bucks and cover our commissions. So I like using these strategies around earnings because you're only giving yourself risk in one direction. You're utilizing the sale of high extrinsic value options, and that's what we're trying to sell, and that is one of the best ways I've found to use those strategies. So I hope that helps. I also wanted to make sure you are aware of a course that Bruce is doing. He has already taught the strategy portion of this, but you can absolutely get the recording. So if you'd like to come join us for the live trading that's actually going to be tomorrow, July 14th, get the recording of the class. You can still sign up for all of this, and that'll be available to you at the end of this video. So I hope it helps. You guys have a great night.